All right, let's get in Matt Orton, the Chief Market Strategist at Raymond James Investment on the show now. Matt, thank you very much for joining in. U.S. markets completely shrugging off the geopolitical headlines coming out of Venezuela. To be fair, it doesn't affect the theme which is dominating the U.S. trade, that is AI. That still continues to remain intact. But as we begin 2026, give us the big calls that you're taking on the U.S., on India, and even India's position in the emerging markets.
Absolutely. Well, good morning, Raymond. Very happy New Year to all of you. And I think the U.S. looks poised to continue to grow, as do all global markets. I'm quite optimistic on where we go in 2026. And while I like artificial intelligence, we've talked about this over the past year, my enthusiasm and my belief that we were not in an AI bubble, I do think 2026 is going to be a year of differentiation and more of a show me year. It's going to be very important, especially as we head into earnings season, given how much so many of these AI companies have moved, that the higher quality names that are not seeing deceleration or facing that law of large numbers, those are going to be the winners in the AI trade. And those who are not able to continue to push EPS growth higher, I think they're going to be challenged given the strong performance they've had. So when you extend that to a global perspective, I think leaning into cyclicality is a winning play for 2026 in the US. That means leaning into financials and industrials, even those associated with data center buildouts, but also those just based around manufacturing and beneficiaries of fiscal policy. In emerging markets in Europe, I think it's a similar trade. Leaning into cyclicality with respect to financials, I think continues to look very, very attractive. In India, same thing. HDFC continues to be my top overweight in the financial space. ICICI looks like it's starting to pick up a little bit too, and I think adding a little bit more there, especially heading into what should be a good earnings season, I think looks attractive. And the rest of Asia as well. I think there's a lot of opportunities to lean into that trade and also use downside opportunistically, because there's going to be increased volatility given where geopolitics is, given where valuations are. So you don't need to chase the market as an investor. Let it come to you, but be prepared to put money to work, because I think the fundamentals support continued upside.
In India, IT services, for example, Matt, good morning and Happy New Year, have been actually the two sectors, real estate and IT services, which are, double-digit down in 25. IT, as the conversation moves away from the infrastructure companies and the AI to the adopters, you think there's underperformance aside. Perhaps is a necessary condition for outperformance. But do you think, the ability of IT companies to sort of play into the theme of adoption, to cut costs, to use AI, enables them to do well this year?
Prashant, that's a really interesting point, and it's one I've been spending a lot more time discussing with clients and doing a lot of fundamental research on, because I do think this is going to be the year of AI users as well as the AI enablers. And I think companies that are able to integrate AI to preserve their margins in the face of, I'd say, more persistent inflationary pressures, I think that's going to be a really important theme, not only this year, but in the next few years to come. And so when you look at Indian IT services, it's been an awful place to be over the past year, but you're starting to see a change of hearts. And I don't know whether that's because some of the charts are just so washed out that investors are trying to dip their toes in. But you look at some companies like Tech Mahindra, where the CEOs put new plans in place, even Infosys, given its global exposure, especially to asset managers who are benefiting in this environment, you're starting to see the outlooks change and turn a little bit more optimistic. And so I have my eye on the space. I'm not quite ready to go all in, but I am looking at dipping my toe, because things are so cheap there. I think there could be opportunities. But again, it's a show me market. You have to prove yourself before I think investors are going to put more money to work.
All right, Matt, good morning, and wishing you a cracker of a year in 2026. I recall when we chatted last, you were looking at some of these companies, Swiggy, a case in point. Sure, they had a rocking New Year because, deliveries are very, very high. There's a bit of a conflict going on as well on ground out here. But what's your view? These stocks have come off the top, Swiggy, Eternal. Have you got into them?
Yeah, so Swiggy is a name I own. Eternal is a name I have owned for a while. We talked about Apple AI as well, and I think when you look at all of these, I'll call them more, higher beta names, but especially the Swiggy Eternal that are related to the consumer. When I look at the name Swiggy in particular, there's a lot of ground competition for sure, but that can't last in perpetuity. There's only so much cash these companies can burn. And what I like about Swiggy is that it has shored up its credit lines. It has money it can put to work to invest in higher value propositions. You're seeing returns from some of its cart enhancements that it's made. So I do think we're going to see a little bit of a turn, and hopefully the GST reforms really start to positively impact consumption as well. And so I like being exposed to the Indian consumer, and I think Swiggy looks fairly cheap. It's had a rough go in 2025, and I think it's set up to do well looking into Q1, Q2 in 26.
Matt, the other big talking point are the monster rallies that we continue to see in base metals, not just precious metals, which had a banner year last year, but look at copper, look at aluminium, platinum, going through the roof. What are the implications for global equity markets with this kind of a rise?
Is bullish, Rima. I think the moves in base metals is certainly a signal back to that cyclical element we talked about at the beginning. I think it highlights that global growth remains resilient. So I take that as a very positive signal, while maybe some of the moves in silver, for example, which does have industrial purposes, might be a little bit extended. When I look at the moves in copper in particular, I'm very enthusiastic about copper and copper miners moving forward, because copper isn't just used for very, call it CapEx heavy areas. It's also used in data centers. It's used in chips. It's used in more EVs that China continues to invest in. And so I think there's a lot of use cases for it, along with significant underinvestment on the part of the miners. So you actually have increasing demand that's outstripping the increase in supply that we have. So I think copper looks like a very constructive market. And I think that's the story for some of these space metals going forward. So I do think that's an area to look for, maybe a positive surprise in 2026 across the commodity complex and other miners outside of the gold miners.
Matt, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for joining us here. Happy 26, and hope you continue to do well.